In this video, I will be demonstrating straight line depreciation. On January 1st, 2028, Kemp Company purchased a machine for $20,000. The company estimates the machine's life will be 5 years and the residual value at the end of 5 years will be $2,000. So we are to compute depreciation for all 5 years. So next you see the formula. Straight line depreciation formula. Remember, it will be different for other methods. So the straight line is the simplest, easiest one you can work with. So the cost, this is historical cost, minus the residual or salvage value means the same thing. Then you want to divide that by the estimated useful life. So 20,000 minus 2,000 residual value would be 18,000. And then divide that by 5, so you end up with $3,600. And this is the amount that will be recognized each year, so each 12-month period. Machinery was not purchased in January, but instead, let's just say that it was purchased in July. Let's say July 1st. So for a full year of depreciation would be $3,600. But if it was purchased July 1st, that would be only half of a year. The amount for half a year would be $1,800. If it were purchased at some other point, maybe in March or in November, whatever month it's purchased in, you just multiply it across by that time component. Now do note over on the right hand side here, I want you to just be familiar with this. The straight line rate, when we say what is the straight line rate, it is actually 1/5. That's 1 divided by the estimated life. So 1 divided by 5 in this case. It could be a different number depending on the problem. It could be 8 years. It could be 10 years. 1 divided by the estimated life. When you just pull out your calculator, 1 divided by 5, you get 20% or 0.2. So I just used a different, well, I used the same example. So the 18,000, which is your cost minus salvage value, 18,000 times 0.2, still gives you 3,600. So it works either way, whichever way you're comfortable working it. But I want you to become familiar with this straight line rate because we're going to need it when you watch the video that deals with the double declining balance method. This again is your straight line method. Now let's look at what that journal entry would look like. So each period, so at least annually, but a company could divide this number further by 12 and recognize some portion of this depreciation expense each month. So you would debit depreciation expense, accumulated depreciation for the equipment would be the credit side of that entry. Remember, accumulated depreciation is a contra asset account. It increases on the credit side, carries the opposite side balance to the asset that it's going to pair up with. So in this case, the equipment. Now let's look at what these ledger accounts will look like. And I have a depreciation schedule also in place here to show how the depreciation expense accumulates over time. So of course we have in the assets, we have an equipment account there with a debit balance of $20,000, which was the amount that was paid for this particular asset. Accumulated depreciation, so over time, remember we're making that same entry. The depreciation expense is debited, accumulated depreciation will be credited. Year 1, year 2, 3, 4, 5. So at the end of year 5, the total amount that has accumulated in the depreciation, in this accumulated depreciation account, $18,000. And that's really just where we want it to be because remember over on the right hand side, this is where the company wanted it to be with the residual value. So balance sheet, you would have your current assets, then you're going to have those plant assets, which is actually where we are. The equipment's going to be listed at the historical cost, accumulated depreciation. The total for year 1 would be $3,600. For year 2, then would add together to be $7,200, all the way down. At the end of 5 years, it's going to be there's going to be a total of $18,000 in that account, which means the equipment net at that point is $2,000. Does not mean that's all it's worth. It does not mean the company has to sell it. It does not mean the company has to stop using it. It just means we stop making that journal entry for depreciation expense on that equipment. And just look at it. Book value, we started off with $20,000 when the equipment was purchased. Year 1, we have depreciation expense $3,600. Accumulated depreciation for just the 1 year would be the $3,600. Book value. Book value is this $20,000 minus the accumulated depreciation. So for year 1, it's going to be $16,400. Now for year 2, we have depreciated another $3,600. So now this accumulated depreciation is $7,200. Back to $20,000 minus $7,200. Balance now $12,800. Book value. This is the same as your net that would be carried over here on the balance sheet. It changes every year. Year 3, another $3,600 is added onto this account. So accumulated depreciation now $10,800. New book value $20,000 minus that $10,800, $9,200. Depreciation expense $3,600 in this account. Remember, we're adding all these up here. So the fourth one added on $14,400. Go back to your $20,000, which was your original value, minus the $14,400. Now the book value $5,600. So we're doing this every year. And we get to the last year, we take another depreciation expense on this equipment, add it to the accumulated depreciation account. We end up with now $18,000 in that account. So the book value at this point, again, we're just doing the simple math here, minus the $18,000, balance $2,000. And this would have occurred on each of these items. I've gone back and just included the calculations here over on the right hand side so you can see where the book value comes from. In case I was zipping through there a little too quickly for you. So each time you go back to cost and you're subtracting the total in that accumulated depreciation account to get you to the book value.